Hello, everyone. Thank you for joining us. Welcome to the latest installment of the Tax Analyst Conference Series. I'm Bob Goulder, your moderator. I'm speaking to you from beautiful Rio de Janeiro, Brazil, the host city for the 2017 IFA Congress. Tax Analyst is delighted to be among the sponsors of this prestigious event. By way of background, Tax Analyst is the nonprofit publisher of tax notes and many other fine magazines. This marks our 15th year of holding public discussions on tax policy and practice. Today's panel will focus on the possibility of fundamental tax reform. Many countries around the world have reformed their tax code in recent years, but the United States is not among them. In fact, tax reform hasn't happened in the United States for many decades, since 1986. But now, a variety of stakeholders are clamoring for a major rewrite of the Internal Revenue Code, particularly those portions relating to multinational corporations and their foreign activities. Back in Washington, D.C., where we're based, we now have one political party that controls the White House, the Senate, and the House of Representatives. So, to repeat an old cliche, the planets could be aligning for tax reform in the near future. That said, we don't have an actual bill yet, but nevertheless, it's been a busy year for tax reform. And there are a few related themes we hope to address during the next hour or so. First, there's the House blueprint. It was about 14 months ago. The House leadership released this document that got everyone's attention. It included the now infamous destination-based Cashflow Tax that we've all heard so much about. Such a system would have been transformative if it had been politically viable. Second, you have the leadership in the Senate kicking around ideas about corporate integration. And I think that's significant because properly integrating the treatment of C-Corps and their shareholders is a long-standing policy objective and one that's proven elusive in the past. And then there's our executive branch. The White House has promised ambitious tax cuts, as well as some simplification. Back in the spring, they released a very brief outline describing their priorities for tax reform. And that one-page document, well, it was so brief that it essentially punted on any valuable details you might want for tax reform. But at least now we have an Assistant Secretary for Tax Policy who's been confirmed by the Senate. Hopefully the wheels of tax reform are beginning to turn. Bottom line, there's a lot for us to discuss today. And to do that, I've assembled a exceptional group of commentators who I'd like to introduce right now. Seated to the far right is Mindy Herzfeld with the University of Florida's Levin College of Law, where she is a professor of tax practice and director of their LL.M. program in international taxation. She's also of counsel to the firm Ivins, Phillips & Barker, and many viewers will be familiar with Mindy through her insightful writings in the pages of tax notes. Seated next to her is Daniel Berman, former regional international tax leader of RSM US. He's now responsible for international and strategic projects for the firm's national tax practice. Dan's also an adjunct professor of tax law at Boston University, where he previously served as director of their graduate tax program. He's enjoyed multiple stints in government in both the executive and legislative branches, serving as legislation counsel to the JCT and deputy international tax counsel at Treasury. Seated to my immediate left is Allison Christians, the H. Hayward Steichman Chair in Tax Law at McGill University in Montreal. Viewers might be familiar with Allison's exceptional blog called Tax, Society, and Culture, where she routinely speaks her mind about pressing issues of the day. If you haven't checked out that blog, it's worth looking at. Allison also has the high distinction of being a general reporter for this year's IFA plenary session on assessing BEPS. That was a very good program this morning. Thank you for your involvement with that. And then down at the far end, last but not least, is Peter Blessing, who's a member of the Complex Transactions Group and International M&A Group within KPMG's Washington National Tax Practice. Previously, Peter was a partner with Sherman & Sterling, LLP, and he's also president of the IFA USA branch. And prior to that, he served as a member of IFA's Permanent Scientific Committee. And I'd also mention that Peter's a former chair of the New York State Bar Association's tax section, a very valuable group. That's it for the introduction, so let's get started. And I would like to begin by asking a big picture question about tax reform. Initially, this is for the whole panel, but initially I'm going to aim it at Mindy. When we talk about tax reform, we hear this phrase, broaden the base, lower the rate. Almost as if it were a formulaic prescription for tax reform. It's presented often as a gold standard, a best practice. But when I think about this model, I wonder if you follow that, you end up preserving many of the design elements of the current regime that maybe aren't so favorable. It almost seems to me that this mentality of broaden the base, lower the rate, it seems to suggest that tax reform works best as an exercise in incrementalism. And I'm not sure if that doesn't sell us short in terms of what could happen if government decides to go big. For example, when we examine the House blueprint, I don't think I would consider the House blueprint in that category of broaden the base, lower the rates. It would have given us a substantially different system. It would have moved us to basically a cash flow regime. So the question is this. What is it about cash flow treatment that is so appealing to economists, academics, and a whole host of other folks?
Yeah, so I think there's a couple of components to your question there, but I'll take specifically the cash flow treatment first. I think the problem when people talk about base broadening as a way to lower the rates, there's not enough broadening that you can do within the current income tax system to really lower the rates. And that point, I think, was really brought home to me when the Senate held a hearing on tax reform about a month ago, and there were 4 former assistant secretaries of tax policy who testified there, and really there was general consensus on that point. We will not get to where we need to be. There are substantial elements of our current system that need to be reformed in a way other than just lowering the rates and broadening the base to get us there. So what the cash flow tax does, if we're stripping out the destination-based aspect from it, I think allows us to think about our tax system in a fundamentally different way, moves it more towards a consumption-like tax that allows for really a different revenue source that goes beyond the current income tax. Now, a pure cash flow tax is not, the way it was conceived by the blueprint was really an income tax and not a consumption tax, but I think that's the direction we need to go in. Just thinking about broadening the base in order to lower the rate is not going to solve the real systemic problems that cause distortionary behavior by business, by taxpayers, and won't get the revenue that the country needs.
Others have a thought?
Yeah, I was just going to ask Mindy, how does the destination-based cash, or forget just the cash flow tax, tie in with progressivity, our policy objectives of distributional effects? We want to have a progressive system.
Yeah, I've just been reading a lot about that for the class I'm teaching in tax policy, and I think that there's some consensus that you can have a tax system that looks more like a consumption tax and make it be progressive. But at the same time, there is an acknowledgement that when you try to make that work in the real world, it will always be less progressive than an income tax. And so I think that's why most of the U.S.'s large trading partners and other large economies have all gone to a kind of dual system that's partly a consumption tax and partly an income tax. One allows for greater progressivity and one allows for the benefits of an alternative revenue source and not having the income tax be as distortive on taxpayers' behaviors as it is.
But I think there's a big difference between having a combination in your tax system of an income tax and also have a value-added tax, and having one tax that has elements of a consumption tax and elements of an income tax. Most of the rest of the world, most of the rest of the developed world has the former. They have an income tax, they have a value-added tax. Nobody, I believe, has what the House blueprint proposed, a combination that they can pretend is an income tax, they can argue is primarily a consumption tax in terms of the benefits touted by economists of a consumption tax, but they put it all together in a way that nobody can really understand. During what you might consider of the pendency of the House blueprint proposal, there was an awful lot of analysis being done, economic analysis by some very smart people to try to figure out exactly what that tax was. And to my best knowledge, they never did exactly figure it out. It had some elements that were just absurd, that of course caused it to be unacceptable politically. Among other things, it would have put the largest retailer in the United States out of business. It would have made a company that does a lot of exports and makes a very healthy profit in a negative income tax situation permanently. It's presumed by the economists, and some people were not convinced about this, but those problems supposedly would be ameliorated by an expected 25% appreciation of the U.S. dollar relative to other currencies in the world, which, as Michael Gratz projected, that would move, it would reduce the value of foreign currency denominated investments held by U.S. persons by $4.9 trillion and transfer in the other direction the value of $8.1 trillion to foreign holders of U.S. denominated investments, such as the Chinese holders of U.S. Treasury bills that get attacked all the time as being un-American and dangerous. So we're moving $13 trillion of value away from Americans to foreign persons. And notwithstanding that it would destroy the U.S. tax treaty network, and notwithstanding that the WTO is sure to shut it down as soon as they have the opportunity to consider it. The WTO has been very inhospitable to efforts by the United States in the past to make what we might consider minor border adjustment elements, to put minor border adjustment elements into our income tax system. And if we all of a sudden have a tax that is highly border adjustable, and we call it an income tax, the WTO is not going to look at it closely and say, oh no, it's really mostly a consumption tax, so that's okay. They're going to say, you call it an income tax, you can't do that. End of story. It's just an absurd type of proposal, but Mindy's right. You don't get, broadening the base and lowering the rates that was the mantra of tax reform in 1985, 1986. And at that time, the U.S. tax code was really riddled with benefits and preferences that deserved to be removed, and most of them were removed. There's still some left, but not enough to produce the kind of revenues that people are talking about. So you have to think bigger picture. When the Newt Gingrich revolution led to the Republican takeover of the House of Representatives, the election of 1994, after I think 54 years of Democratic control, the control of the House Ways and Means Committee, which controls the tax agenda of the legislative process, fell to Bill Archer, who had been the ranking Republican on the committee, and that position meant that he was never invited to be in the room when anything of consequence was discussed or decided, and all of a sudden he was in charge, which one could expect would produce some kind of a change in policy or process. And he used to say that he wanted to tear out the Internal Revenue Code by its roots, and that sounded like a big picture tax reform idea. And that was, so he took the gavel 22 and a half years ago, and we have not seen tax reform since then, despite his best intentions. So it's a tough thing, but the consumption taxes are favored by a lot of people as non-distortive. They can raise a lot of revenue. They tend to be regressive. Every other country in the world, almost every other country in the world, has one in addition to their income tax system. So notwithstanding a comment by Eric Cantor, former Congressman Eric Cantor, shortly after he was selected to be House Majority Leader a number of years ago, he was asked whether he had any interest in a value-added tax. And his response, I'll try to capture the sneer properly, he said, "They do that in Europe. Why would we consider it?" Well, we should consider it, and we should consider it the way that it is known and implemented and done, rather than in some new approach that nobody can understand. We should have a corporate income tax. We should lower the rates as we need to for proper incentives. We should make the base broadening efforts that are appropriate from good tax policy. If we need to reduce individual income tax rates for political reasons, we can do that. We can pay for it with a VAT and increase the progressivity of the income tax, which is progressivity adjustable in an income tax. Increase the progressivity of the income tax to account for the regressivity of the value-added tax, and that makes sense. And this isn't original to me. People are proposing this, and that makes a lot more sense than what the House blueprint had.
So Dan, I think I agree with you on. I think a lot of the problems that the blueprint ran into was due to the fact that it wanted to have something like a VAT, but it was afraid to call it a VAT, and that's how it ended up getting twisted up into itself. And the other way it ran into problems was that it, when it wanted to try out this really bold and interesting idea, it only would do it 100% of the way. So whereas a lot of people found the idea of a destination-based cash flow tax appealing because the blueprint and even for the full year after it was issued until the joint statement on tax reform killed it, the House leadership never indicated that they would be willing to go anything other than 100% for a destination-based cash flow tax. Whereas if they had floated the idea for something less than 100% replacement of the corporate income tax, maybe more people could have stomached it.
Something like the Grex plan, maybe? Or
it was something that would end up looking more like what other countries have, partial income tax and partial consumption tax. So that wouldn't have terrified all the retailers that thought their business, that would be the end of their business.
Yes. And Walmart has 2 senators themselves. This half of the table. Broaden the base, lower the rates. Right. Incrementalism, is that selling ourselves short? Or
I don't think broadening the base is the be-all and the end-all. The current proposal is still, I think, expensing is still very key to that. And if you have complete expensing and pay for that with a disallowance of the interest deduction, which has been a proposal still on the table, I think that's pretty dramatic. I think that's pretty transformational.
Wait, by complete expensing,
it's narrowing the base, in fact, in terms of the capital expenditures.
But what is current? You mean full expensing?
100% expensing. If I buy everything other than
refund.
Perhaps everything other than real estate, I get a total write-off.
Yeah, but refundable, not building in an NOL with an interest charge.
That would be the ideal, yeah. And everything in our tax reform process hangs on the budgeting, yeah. And it's very expensive. Yeah. Like everything costs money, and at the end of the day, that's why the process is dragging on now, and with a lot of uncertainty, because one of the biggest question right now is how do we pay for things? Yeah. Everybody has great ideas, but we'll see that in the corporate integration proposals too.
It's also the optics of the refundable losses.
The appearance that you're giving.
Yeah. Writing checks out to
yes.
It will have optical effects when depending on the nature of the taxpayer, if you start to see the wealthier taxpayers taking advantage of it by timing, and so end up paying no taxes, getting actually refunds back, then we'll have some negative optical
It
effects.
starts to resemble a subsidy program rather than a tax.
Yeah. So I'll just add to that in the last time the cash flow tax was kind of in the public imagination was in the 90s and 94, 95, Auerbach and so on. Harry Grubert, of course, had some proposals, and Canada's government commissioned a study to study the Canadian tax system, and in that they actually did look at the possible switch, right? An actual switch to cash flow tax. Concluded one of the reasons that it was unacceptable is that it would be a narrower base. And just as a general principle, the broader base has to drive the tax policy bus. Whether that describes any system we've ever seen in the long term is sort of irrelevant. But that was the first one, that it would be narrower than the corporate income tax base. But the second was that it would undermine the individual income tax base in a way that would be unacceptable. It would just hollow out the individual income tax base, and so couldn't be supported on that ground. It would just destroy revenue from the one that you really need, which is personal income tax. And I think when you talk about the optics of it, it's important. But there is a structural problem if you build your tax system on what is structurally a regressive tax, and you have to count on transfers to accomplish what you're talking about, which is some kind of progressivity. So you can do that with a consumption tax, but if you don't have any political way to get cash transfers out to those who suffer under regressive tax, that's hard to build. So in Canada, you can do that. People are not offended by the idea of cash transfers to lower income constituents, but in the U.S. this seems like an almost impossible dream, right?
Well, some it's not something they really think very much about.
Yeah.
I think the current political environment, and the current the leadership of the parties at this point that's not their top priority. Their top priority is growth, and anything that promotes growth in a sort of a hyper way, even though the economy, I think, is actually doing quite well. Mm-hmm. But a stimulus on top of stimulus is a good thing, and expensing does that. And it has disadvantages that aren't considered as important as they were maybe 20 years ago.
Yeah.
Can I ask
Absolutely.
that I've been mulling over because I read this somewhere and can't figure out whether I agree with it or not. That introduction of the VAT in Europe and raising VAT rates and lowering income tax rates has led to those countries being more unequal. Mm-hmm. Do people think that's right or not?
Well, America seems to have an inequality problem without a federally harmonized consumption tax. Right. So I would be skeptical. I want to see the research.
Yeah, I think conceptually, though, so a number of the countries, like I believe Germany has an exemption for individuals holding capital assets past a year or 2 years or something like that. And if they do, they can reap the benefits without having a dividend payment. Let's assume it's wealthier people that tend to do that more than other people. If the corporate income tax is also at a reduced rate, the prices corporate income tax rate, the values of the shares tend to increase. The VAT, on the other hand, is more or less born much more regressively. So I think that tendency. That's why I think the tendency is what Mindy says.
I was quoting something I read.
Allison's a good person to quote.
Oh, that's
but those elements are adjustable, though. I mean,
they are. We're just talking about whether one chooses to do so.
Yeah,
every adjustment.
Right. But I think the most
I think Allison
cases
made this point. Every adjustment is a complication, and I think something we lose, sight of sometimes is keeping our system administrable and understandable, and therefore compliable in a voluntary way.
Mm-hmm.
Yeah.
Right.
Yeah, no, I think that's right. Mindy, I think you just mentioned looking at introduction of VATs in Europe, but I think the most recent cases aren't the most recent introductions in Australia, in Canada and Australia, rather than Europe, of a national VAT. Yeah.
Yeah, I guess I'm not sure. I don't have a global picture of who's adopted them more recently, but Canada has a national VAT that has always had. I mean, they call it a VAT refund. It's not a VAT refund. It's a cash transfer based on income. That's income tested, and not how much did you actually spend in VAT, and then you get some back if you're in the lower bracket. It's how much income do you have? You get a cash transfer, which in theory should make up for the regressivity of the VAT.
Well, we have the earned income tax credit, which is a cash transfer.
Right.
Lower income people, and there's no question about that. Yeah. They just run it through the income tax system.
Yeah, so that's true. So that's a good point. So it can be done. We have this impression that, well, and this is always the story with the broad-based low rates, where you have broad-based low rates and then you have cash transfers to make up for inequality. Well, or you have a VAT, you have a regressive tax, and you have cash transfers to make up for inequality. And the issue is we always seem to get the tax part, we get the regressive tax part, but we don't get the cash transfer part. And that one always has to wait for another day. And there's always seems to be more appetite for reducing a corporate tax rate, regardless of the, what that means.
And aren't those transfers by some folks viewed as just another entitlement program? And we have a political environment where people are talking about, oh, we need to cut back entitlements. And here we'd actually be introducing a new one. Now, it might not actually be an entitlement because its purpose is to alleviate regressive tax.
Well, the earned income tax credit also is notorious for abuse and complexity. And it's very hard for the people that are entitled to it to figure out what they need without getting assistance, and yet there are others that take advantage of it. And so that shouldn't be.
Right. Well, that's purely because it's a spending program that's not being run by the part of the government that does spending programs. It's a spending program run by the part of the government that collects revenue. And collects revenue in a complex way because we have a complex economy, and you can't simplify the whole internal revenue system for the benefit of the poor people who have simple situations and shouldn't have to deal with such a complex tax system, where they should be applying to an agency that has simple process, simple procedures, and a simple arrangement for collecting these transfer payments. But it's easier for or should we say the Ways and Means Committee, the Ways and Means Committee is always called the powerful Ways and Means Committee, and the chairman is always called the powerful chairman of the Ways and Means Committee. They have power, and they like to exercise power, and of course, control over a program, whether it belongs in your jurisdiction or not, is one of the ways that power is exercised in Washington. So they took it.
Allison, why did you say we always forget about the cash transfer part?
No, I just mean it's don't you think it's a harder sell somehow to get that into the...
Yeah, I was just curious why you said it right after talking about how Canada has a cash transfer.
Yeah, I know. I mean you. Thank you. So, well done, Mindy. You have exposed me. In Canada, we don't have the same political history around redistribution that the states have. I think we have a different view of the social safety net, of the role of the government in I don't know, spreading it around. Wasn't that how Barack Obama put it? Spreading it around, right?
Are you suggesting cultural differences between nations?
No, I would never presume to go there. But yeah, isn't there some? I think that's my experience is that. Or my observation, not my experience, my observation is that you can really get a lot of people fired up talking about technical plumbing, about how to get a tax system to work this way or that way. And you cannot get the same kind of public conversation around the cash transfer, because like those problems that you're talking about, I've heard a lot about how difficult the EITC is to implement and how much trouble there is for the taxpayers. They're spending a lot for compliance, and they're getting bad services. And this is not a new story. This has been known. This has been written about. People have been complaining about it, but there's not much action to actually fix it. And it's possible to fix, right? I mean, this is possible to do. As a plumbing.
I assume it is, but I assume they adopted a rather complex system because the problem's rather complex.
Right.
Okay, so fair enough. Yeah.
You have large numbers of people receiving small amounts of money, and you're trying to...
Yeah.
So that makes it a there's a lot of plumbing that has to go into that.
There is, and I think that maybe because Canada's got a smaller population to deal with, so this just makes life easier. But the government is actually sending checks, to everybody that's entitled to a VAT refund, a consumption tax refund, sending checks to people who are entitled to the child tax, benefit, which is a cash transfer. Not, it's not done through your tax return.
Well, we have refundable child credits as well that again are done through the tax return.
Yeah, but you send a check.
They send a check. They get a check. Yeah.
I'd like to go back to the VAT. 175 countries have it, and in the last thanks to the VAT, thanks to the border adjustable tax, we have had some dialogue about VAT among politicians, at least, maybe not among the public at large, but I think that some of the opprobrium that was associated with it, or the third rail aspect of it, is starting to dissipate. So I personally believe we will see that sometime in the next 10 years. And I'm curious whether the other panelists, maybe we should take a poll.
Well, so I think you're exactly right that I think the border adjustment tax, which everyone views as a big failure, actually paved the road. Because what I see every time the discussion comes up among tax directors, corporate tax directors, there was a poll taken at the Tax Policy Council, TCPI, and there's just a lot of support now among the business community for that. And so you think that somehow that has to be chipping away at the political fear among politicians of enacting of that.
Well, I just want to say that this whole thing of the VAT as the third rail of tax politics is a myth.
The only problem is it's a myth that the politicians believe.
Well, some of them do,
and we agree it's eroding. But,
yes, but they shouldn't. They're misunderstanding the history. And the history is that L.L.M, who was the very powerful chairman of the House Ways and Means Committee and a Democratic congressman from Oregon, had said something about, had expressed some kind of openness to at least thinking that maybe a VAT existed, and he lost his seat in the election of 1980. But other things happened in the election of 1980. Jimmy Carter was a very unpopular president who ran for election in 1980, was trounced by Ronald Reagan, and he conceded the election around 9 o'clock Washington time, Eastern time, which was a good 2 hours before the polls closed in Oregon and California and Washington and Nevada. And lots of people in the United States vote on the way home from work. And when Jimmy Carter had already conceded the election, a lot of those people didn't bother going to the polls to vote for Jimmy Carter, and accordingly they didn't vote for L.L.M, and L.L.M lost the election. So we have somebody like Byron Dorgan, who when he was a congressman and a senator used to say, he was talking about L.L.M, he said, the last guy to talk about a VAT doesn't work here anymore. Well, I had a meeting when I was in the government with somebody else who didn't work there anymore, a congressman from California named Jim Corman, who also lost his seat in the election of 1980. And he never said anything about a VAT. And he was a member of the Ways and Means Committee, and he blames his election loss 100% on Jimmy Carter's early concession. So,
but yet 37 years later.
37 years later, because people like Dorgan keep saying this about L.L.M, but it was Jimmy Carter. It wasn't VAT.
Yeah.
Myth debunked.
Definitively.
Yeah. Well, need to move on now, and I wanted to, speaking of complex issues, talk a little bit about transfer pricing. And this is another question aimed at Mindy, but I'm sure other people will have some input. So, Mindy, you've been writing a lot about tax reform recently. One of your excellent pieces on the border adjustment I thought was fascinating because it focused less on the treatment of imports and exports, and more on the big picture implications related to transfer pricing. You wrote this, and I'm going to paraphrase you if you don't mind. but it's very well written. The appeal of the border adjustment is that it forces a fundamental rethinking of the arm's length standard, a standard that is under attack around the world. The BAT is attractive because it removes from economists who struggle to develop and justify coherent methods for applying an arm's length standard in the wake of the OECD's BEPS project, those decisions about how to allocate a company's global profits, close quote. That's outstanding, punchy stuff. I remember reading that and jumping up out of my seat
Credit
saying,
to my editor.
I might be attributing too much here, but it sounds like you're almost saying, or implying, the only way to really deal with transfer pricing is to ditch or jettison the income tax as we know it, do some sort of radical tax reform like cash flow treatment, because we can't cope with transfer pricing, or we can't cope with the arm's length method under our current system. I'm probably guilty of reading too much.
I think that's exactly what I was trying to say. I think when I look back on the past 3 years, I guess, of BEPS discussions on transfer pricing, I think it's all about struggling with a system, with what's in theory an economic principle, but makes no sense really, that you've got to price things as if there were transactions between third parties, but of course, multinational group, the whole reason it makes more profit than it would as standalone companies is because there are synergies. And so that's an inherent tension within the arm's length standard that no amount of BEPS rewrites of the transfer pricing guidelines is going to be able to fix. And a lot of the discussion that I missed the panels this morning, but I saw some of the tweets on it, and developing countries wanting thinking that they're not getting their fair share under the current transfer pricing rules. So we keep trying to rewrite the transfer pricing rules to address these problems, but the arm's length standard can't fix them, and no one really defends the arm's length standard as a matter of principle. The best defense that anyone has is that it's better than anything else. And so, well, if someone's come up with something that could be better than that could be that anything else that's better than the best thing or a better thing, yeah, why not try it? If we come up with a methodology that says we can allocate profits based on sales, then, and we don't have to deal with trying to fit the arm's length standard into a metric that is impossible to work through, then yeah, that's what I was trying to say. So that's
what you said, and you're sticking to it.
Well, I haven't heard an argument at all recently that the arm's length standard is better than anything else. What I've heard is that the United States led the world to the arm's length standard and forced the world to adopt the arm's length standard, so we cannot be heard to back off from it. And if we cannot back off from it, then no one else has the guts to stand up to us and back off from it, so the whole world is stuck with it just because we did it. That's not much of a justification. I mean, the whole, as Mindy says, the whole thing doesn't make any sense. You're trying to identify a transfer price in a hypothetical transaction that in many cases does not and cannot exist. As David Rosenblum suggested many years ago, it's like asking the question, if I had a brother, would he like cheese? It's as hypothetical as that in many cases. We're trying to find the right answer when there is no right answer, when maybe we should think about finding a different answer that may not be precisely the right answer, but might be an answer that would work, an answer that people could accept, and perhaps second best is the best we could do, and maybe we ought to go in that direction.
I would just say second best is not necessarily limited to a destination-based cash flow tax.
Oh, I wasn't suggesting that was the second best that we should think about.
So, I mean, when you get down to it, the issues with transfer pricing all relate to intangibles, and therefore a lot of the pricing of these transactions has been trending towards profit splits, because it's a customized formulary apportionment, essentially, that takes into account all the factors. If you combine that with a commensurate with income, what we call commensurate with income adjustment, but a post facto adjustment mechanism, I think you find that a lot of the issues can go away. That still, there's a separate issue as to whether a country wants to allow its IP to be moved to a jurisdiction on a fair price basis at all. Because, I mean, even a fair price basis does eventually mean that if it keeps growing in value, you've lost those revenues. And it's very, under today's regime, it's very easy to move it to a country that doesn't even necessarily need a tax treaty if the IP is just priced into the goods of into the goods that are sold into the destination country. There's no withholding tax today on goods. So you're left with that kind of an issue, but I don't know if at the end of the day it justifies by itself going to a destination-based cash flow tax.
Transfer pricing, what do you think? Is there hope? Can we get it right?
So I have not heard the argument that the reason to hang on to transfer pricing is the U.S. built it and now has to save face or something and can't abandon it. I've not heard that, but what I have heard is that arm's length transfer pricing is something that has been a system that was introduced a long time ago that's been worked on and refined and is capable of being refined further. Whereas if you change to a new system, the transition costs alone are just unbearable, but then all you're doing is sort of replacing one complex system with another complex system that will also have to have all of the kinks worked out. This is sort of the argument I've found.
Well, that would be true. That would be true unless you could say that the new system you're thinking about could clearly be better when implemented than what we have now. Because the other thing you can say about the arm's length method is we've been working on it for a long time, and it's still not very good.
Right, but is it not very good because we're not good at it, or is it not very good because we don't want to be very good at it? I mean, that's a...
It's because the problems are very complex, and the valuation issues are very complex, and at the end of the day, they're often decided by a judge that it's relying on experts who may not, they're not neutral, obviously, and they may not always get to there's no
right result.
Single right answer, and...
So you say we're incompetent,
but in that... One thing I'm saying is that if the tax system on these big ticket transactions is tied to ongoing litigation and controversies, and that's probably not very good. And even the advanced pricing agreement program, which does resolve those controversies, those agreements take multiple years to put into effect, and then they only last for a few years. And But I mean, under today's rules, I do think the bilateral APA process is the best thing we have. It's the right answer.
It's certainly helping. Before we had the APAs, I'm pretty sure that more than half of the docket of the U.S. tax court was transfer pricing cases, and that's not true anymore.
Well, certainly most of the math cases are transfer pricing. That's where it's getting worked out.
That's right.
It's not getting worked out it is getting worked out by courts, but mostly it's getting worked out in math, isn't it? I mean, what's your experience?
They settle some, but I mean, it's not. Some cases do go unsettled, and a country is free to bring suit. It depends on the procedures, but we wouldn't have all of the transfer pricing cases we did. Right now we have the big ticket ones are still going on. Altera is being appealed, Medtronic is being appealed, Amazon might or might not be appealed, so there's. I do think there's a lot of litigation to go around, notwithstanding MAP.
So the other
and MAP is no cure-all itself. I will say, I mean, I do think the destination-based cash flow tax is much simpler. The border-adjusted aspect of it would take the issue off the table. I do agree with that. Yeah.
The other
in a simpler way. But it's a very dramatic change to the system if you're trying to find out.
I think it wouldn't be worth it for the sake of transfer pricing.
Right, that's what I was trying to say before.
And it would only get rid of U.S.
I was just trying to be nice to Mindy now.
It wouldn't do anything for other countries' transfer pricing issues. Those issues could actually get worse. It would only help our.
But then everyone would copy us.
Until everybody else was forced to then adopt the exact same system just to catch up with you.
I mean, that's a very good observation to the extent that to me, one of the major issues with replacing the our system with the destination-based cash flow tax is that to do that in isolation without other countries having reciprocal arrangements or similar arrangements does wreak havoc on the cross-border transactions.
And if the destination-based cash flow tax has the effect of blowing up our tax treaty network, we don't have MAP anymore either.
No, I actually am not sure it would blow up the tax treaty network, precisely because the entire structure of FATCA and information exchange is built on top of the tax treaty network. So if you destroy your tax treaties, then you lose all the IGAs, all of the, well, not all of them, because some of them are based on...
There are a lot that are based on exchange of information agreements.
On TS, yes, but the bulk of them are on the 55 or 56, however many tax treaties you have, and the structure of it is based on that. Yes. And the information exchange in general, the whole structure is sort of built on that.
Well, that could be, it's not that we would blow up the tax treaty network voluntarily, it's that all of our treaty partners would terminate our treaty since they're not, since our tax wouldn't be covered.
They won't, because they didn't do it when you overrode all the treaties with, FIRPTA. What do you call it? Yeah, FIRPTA.
FIRPTA?
Yeah.
This would be a lot. This would be a lot bigger than FIRPTA. To have the whole U.S. corporate tax not be covered by the treaty would be be bigger.
Yeah, big. Yeah.
But Allison, I think the problem with the argument of we've got something, we're still working on it, but why scrap it for something that we don't know anything about, is that really we're not really working with the arm's length standard. All the movement towards a profit split, that's really just coming up with an alternative that isn't based on any solid principles or firm rules. And so countries are kind of nibbling away at the arm's length standard, and so in theory it's still there, but it's kind of going away by itself.
Well, I think I think at some basic level we're uncomfortable with the idea that arm's length transfer pricing is going in a direction where we're not working on principles, we're working with compromises. What can we live with? And that's not comfortable. We want we actually want to believe that our tax system can be defensible on principles. And then, as an academic, I have to say, well, that's nice, but the whole entire tax system is based on a lot of ideas that we have principles, but actually when you look at them. So the source principle is, in fact, based on a lot of compromises. The residence principle is based on a lot of practical compromises that are not, if you try to find the unifying coherent principle to tell you what is right or fair or good or beautiful or truthful, you will struggle in vain. And so this is just one more aspect of that. So my question for transfer pricing, for switch to DD, CFT, and all of that is, if you step back and you say, well, what we're trying to accomplish? If the goal is actually not to have an ability to pay based income tax system, but rather to have a tax system which privileges capital in the name of economic growth, if we've shifted in the goal, then I think, yes, we should abandon income tax. If you're not committed to ability to pay in an income tax, why do you have an income tax? That's the whole point of that tax. If you're just trying to raise revenues, you can do it in a lot simpler way if you don't care about the distribution of the burden.
I just want to interject that in terms of the discussion of compromises, that if you look at every significant provision in the Internal Revenue Code, I think you will see that it was the result of a compromise.
Yeah, I think that's right. And I'm not saying that's wrong. But
that's life.
Yeah, that's life.
Yeah.
But if you believe that the basic foundational principles of the income tax is this ability to pay, that it is the one tax, unlike all the other kinds of taxes, that can get at ability to pay. If we're willing to abandon that idea, then we have to be serious about saying, well, we're abandoning the idea of income tax. We're doing something else. We're doing a payroll tax, a wage tax, plus something. Right? That's what we're really doing here. And if that's the case, then it's for me to isolate transfer pricing is useful in that it shows you the discomfort you feel is the abandonment of principle out of necessity.
I don't think
how far does that go?
I don't think that discussing the arm's length method and talking about perhaps moving away from it to some other kind of compromise. I don't think we have to get all the way to ability to pay, to the top principle. I think we can go only as far as measurement of income.
Okay. Yeah.
Which is less,
And I think there are different conversations about income tax versus consumption tax within one country, which is about redistribution within a single nation, where transfer pricing is about distribution among nations. And so I don't think they're the same discussion.
Well, they are the same in the sense that the reason that you're trying to have a principled allocation of income across countries is that you and each country have adopted an income tax which is supposed to differentiate vertically and horizontally among taxpayers in an acceptable, principled manner. And if your arm's length standard doesn't do its job, then somebody's got the wrong income assigned to them, and they're not being measured in accordance with ability to pay. Now, obviously, this is 10,000 feet, and you don't have. I agree with you. You're quite right. We don't have to go there. We can say this is about measuring income, and are we doing that in a way that we can live with? And if we're not doing that in a way we can live with, but I would submit to you that we have not measured income in accordance with principles ever. Right? We've always said, okay, there are ideals about what income is in a pure sense, but it's not workable, or it's not administrable, or we're trying to build other things into our system, like incentivizing this or that. So we had to come to grips with this idea that either we care about what the income tax is supposed to deliver, and we're going to keep working until we can live with that, we can accept it, or we don't care about that. And if we come to a place where we don't care about that, then we should be willing to give up the income tax. This is not doing what we thought it was for. It's not delivering on the promise and its purpose.
What I thought was strange about the destination-based cash flow tax is that how dramatically it changed from our traditional notions of the residence country having primary taxing right to the source country having primary taxing right. And from our standpoint, many of our national champions, not all of them, but some of them, some important ones, embraced that. But they could only have embraced it on the basis that other countries did not adopt the reciprocal tax, I would have thought. Be that as it may, I do think other countries would. The situation reminds me of the sales tax in the United States, when some states started to adopt sales as a more heavily weighted factor, then they adopted it as the only factor, which is exactly a destination-based cash flow tax, essentially, but with some reduction.
Well, we move on to another important topic, and Peter, this one's aimed at you. We want to talk about integration a little bit. The Senate's looking at it. This is a familiar issue. Can you integrate the treatment of shareholders and C-corps to do something about double taxation, eliminate it, mitigate it? Really, tax scholars have been debating this. I did some research. For almost 100 years, they've been wrestling with that. And there are obviously things that you could do with integration. If you go back and you look at Treasury 1 and Treasury 2 back in the 80s, which is a great place to go for pop music and for Treasury white papers, the dividends paid deduction, you could do that, but then you're turning the corporate income tax maybe into a retained earning tax, and do you really want to do that? And also, the savings are going to accrue at the entity level, not at the shareholder level, so maybe the dividends paid deduction isn't the way to go. Alternately, you could have an imputation credit, where you tax both at the entity level and the shareholder level, and you have a way to basically give the shareholders a credit for the tax that was already paid by the corporation. That sounds complicated. There's issues about, do you do that for all shareholders? There's a depend if they're U.S. residents or not. Big picture, is integration the way to go, and is it even doable?
Yeah. Thanks, Bob. I tend to think it's a good idea. I think it's relatively viable. I'd be interested in others' views on that in a minute. The problem, sometimes people ask, is this a solution in search of a problem? But I do think there are problems that it addresses It's sometimes described as curing all of the problems we have, but it does address the different distinctions that are economists like to point out between different forms of business entities, and you shouldn't have a disincentive to use one form rather than another form, and that's particularly important where there are advantages to operating in a public share context. In other words, we can regulate public companies. There's transparency. We want to have companies operate in public form, I think, they're completely discouraged under our tax laws today. They're just stuck with it. If they go public, they have a second level of tax. And there's also distortions in terms of the form of capitalization of the entity. So you would have distortions between debt capitalization, equity capitalization. I think it deals with both of those issues. Now, the reason it's not always embraced and has a long and tortured history is it's complex because our shareholder base is very different. We have individuals, but we also have different kinds of tax exempts, and we have foreign shareholders. So it's not so easy to just integrate one size fits all, or you at least have to think through it. And politics has been a big issue. But I think the stars are pretty aligned now because the departure, this very sad departure of the border adjustable tax, which did deal with some of those same issues, is an opening for Chairman Hatch's ideas on or embracement of others' ideas is really a better way to put it, on corporate integration. And there has recently, I think it was August 1st, the Alliance for Savings and Investment, which is ASI. It's not a new organization. It's a long-standing trade organization, put in a letter where they detailed how they would like to see a corporate integration proposal go, and they strongly endorsed it. And I'll come back to that. I think some of the other senators, it wasn't just Senator Hatch. Senator Cardin, for example, was actually, prior to Senator Hatch, was endorsing this kind of a proposal. The one objective that it is not necessarily so good at, and the government economist Harry Grubert and Roseanne Altschuler wrote a paper where they felt that it falls short in terms of discouraging profit shifting and inversions because it depends on companies paying dividends. At least the dividend pay deduction proposal that's being put forth to some extent is affected by behavioral responses in terms of paying dividends. But others have not felt it, at least feels it's directionally helpful, and I think that's right. And if it solves those if it helps on those other problems, then it's directionally helpful on inversions and profit shifting. And also dividend payout. And if you have a dividends pay deduction where the corporation pays a lower rate of tax when it pays out dividends, that's going to encourage moving excess cash off of the corporate balance sheet and into perhaps more useful areas of investment. That's considered a plus too. There's some design features that are very thorny to deal with, and we can talk about those, but I think it's got a lot of merit. The ASI that I mentioned, their proposal is an example of everybody wanting the goodies and nobody wanting to pay. It's a coalition that includes, obviously, pension funds and tax exempts and others. So naturally, they're not going to propose that we not do anything but give a complete exemption to the tax-exempt sector. But that would be very expensive since pension funds and other tax-exempt entities own over 25%, maybe 30%, or even more of securities. And foreigners own another 25% or 30% of securities. So you have to deal with those sectors, and it's probably not going to be cost cost viable to have them have a complete exemption. And so, when Michael Gratz proposed something similar, so a dividends paid deduction with a tax at the shareholder level and then a credit for the corporate tax that was saved by the deduction, he would have a withholding tax on tax exempts and on foreigners, which makes sense. But you can design the proposal so it's not so that the amount included on the shareholder's return is, let's say you have 100 of income, a 35% corporate tax. Just keep the tax rate the same. You pay 65 out. The shareholder would gross it up, just like with a wage withholding, or like our Section 902 credit, gross it up, and then subtract out the tax paid by the corporation, and the individual rates would be whatever they are. We have our graduated rates, and maybe it's higher, maybe it's lower. If it's lower, if it's a refundable withholding credit, withholding tax, then they would get it back. You would like it to be if you're a believer that the pension funds should not get a complete windfall, they maybe need some benefit. Because after all, the rates are going down. One of the effects of integration proposals, you have one level of tax where you had two. They should get some benefit, perhaps. But frankly, they would be neutral if they got none. But since other taxpayers are getting a benefit, they may want some too. But you would need some on them. And then foreign investors, I think you need a withholding tax because it's just like our REITs. Today, our treaties have a 30% base. The base withholding rate for REITs is 30% because no corporate tax was paid. So it's not 5%, it's 30. So you need something like that.
Is that where the political opposition is going to come when you start talking about a withholding tax? Because people don't want to withhold?
There's definitely political opposition, and there's also maybe a perception issue. When we were talking about optics before, this certainly has them, because what you're doing is you're shifting tax. I mean, one of the objectives is to shift tax from the corporation to someplace else. Someplace else. And the only other place is the shareholder, right? But you want to shift it from the corporation because of the perception that our corporate rate is too high relative to others, which makes it a target for profit shifting and base erosion. So to get it down, the easiest way to get it down is to shift it to the shareholders, and that's what the Europeans do. They have high individual rates. So one of the political issues is you have to tell the shareholder they're going to have sort of a higher rate but get a credit, which is a little bit more complicated. But I don't, and some of the issues raised by the retirement fund sector are that if a company is going to get a deduction for dividends paid to its shareholders, is it going to have the same incentive to contribute to its retirement plan? And I think the employees which include management, might be willing to give it that incentive, but that has been an objection.
But I was at a hearing where there was a representative from a retirement plan, and she argued, what?
Judy Miller?
I don't remember the name.
Yeah.
But she was adamant that a corporate integration plan would reduce strongly the incentives for Americans to save for retirement.
Yeah, so there are ways to deal with that. I mentioned ASI's letter, and that they have a way to deal with everything, which is to concede and not tax and let them have a complete exemption. So their theory is, well, today tax exempts, they get the dividend, they don't pay tax on the dividend, but they pay tax on the underlying corporation. But if we really want them to be tax exempt, they shouldn't have paid that other tax either. So we just make it all exempt for them. That's their answer to that. And I don't see how that others would say that there's no way to fund that, and that's why, in connection with this, one thing is that the ASI proposal back, it allows, it's not 100% deduction. It's a deduction designed to preserve a 15% effective tax rate. So they use an example. If using all of our, and this is actually from a political standpoint, one of the reasons the corporate integration has legs, it helps achieve a lower rate than you could achieve just by base broadening. So let's say their example would say, yeah, we can get to 25% with base broadening, but we want to get to 15%. So what do? We give a 40% dividends received deduction. So now the company has 75 and it distributes that. But it's essentially with that 40% dividends received deduction, it's getting at a 25% rate, a 10 reduction of its 25 tax down to 15. That tax is shifted to the shareholder who pays 10. If they want to get rid of the net investment income tax, of course, too. Why not? And so let's say the shareholder would have been taxed at 20% federal, now he's taxed at 20 minus 10 or 10. When scholars have approached this question, they're trying to make it a revenue neutral type of tax. So each of these things, sort of comes out a little bit differently. You may not be able to have, you won't be able to preserve the low rates, the tax advantage rates in conjunction with this kind of system. So Professor Gretz would use an example of, or others would use an example of the dividends come out, they're taxed at ordinary income rates, and then you get the credit, and net you have a tax at ordinary income rates minus the corporate tax, whatever percent you wanted to allow as a dividends pay deduction. And so at the end of the day, the rich guy's taxed at 40%, the poor guy's taxed at 25%, and that all works very well. And I think it does work pretty well. In the international context, one of the issues, I think, is by shifting tax from the corporation to the individuals, to the shareholders, within an international context, we traditionally tax shareholders on a residence basis and corporations on a source basis, or at least that's the first cut. So now we're shifting a lot of revenue or tax base to the shareholder level. We're shifting it out of the source country to the residence country, unless we impose a withholding tax. And so that's perhaps the argument for a withholding tax. It's the argument I would make anyway. I think, but the ASI proposal would say no withholding tax, no reduction in interest expense, no withholding tax on interest, no reduction in interest expense, no withholding tax to foreigners or to tax exempts, different than we have today. So none to tax exempts and low rates to foreigners. But that would have the effect, if you had 100% dividends received deduction of a foreign parent company investing in the U.S., of having a total 5% or even 0% tax on earnings, which obviously is a non-starter for many reasons. But I think with the right tweaks, these design features, you go down there, the painful choices to make. And as you getting to your point, Bob, the right choice, unfortunately, is often going to not be politically attractive, and that's why it's not a slam dunk.
Yeah, I think there are a couple of significant political problems here, and one is that if you the way you describe these choices, where the revenue raised from the corporate income tax would be shifted from a place where shareholders and employees and customers don't feel it to a place where they do feel it, would be very difficult politically to tell people to tell shareholders that all of the tax collected by the corporate income taxes, or most of the tax collected by the corporate income tax system, is going to show up on their 1040s. And they're going to have to pay tax on it.
With the deduction. So at the end of the day,
the deduction. But if you're shifting the incidence of the tax, they're going to feel it.
If
it adds up, they're going to feel it. It may not add up. Yeah, I think in most of these proposals, it doesn't add up. And if it doesn't add up, you have a distributional problem. Because although economists can argue to what extent the true economic incidence of the corporate income tax is on the shareholders or the employees or the customers, but a large chunk of it certainly is on the shareholders and the direct shareholders of corporations, especially if you're not giving full integration to the pension funds whose whose owners are more broadly distributed across the income and wealth spectrum. The direct corporate shareholders are largely wealthy people, and if they're getting a big tax break, then that's going to be difficult politically. And the other thing, and this is going outside the tax system, outside the tax world, but we're living in an environment where there's a tremendous amount of public concern and opposition to a Supreme Court case called Citizens United, which said that for purposes of political campaign contributions, corporations are persons. And if a corporation is a person and is permitted to make huge political contributions and influence an election, people are going to want these corporate persons to pay tax. And I think it would be very difficult to take them out of the tax system.
Yeah, that is a comment that just goes to any of the proposals. You're simply saying any proposal that reduces tax rate to 20% or 15%, like all of the politicians have proposed, is a Citizens United problem.
No, it's not.
I just don't believe
no,
it
it's
is.
not.
Yeah.
It's not. It's not. I mean, if you're talking about broadening the base and lowering the rates and saying that the proper corporate tax rate in our system is 20%, that's not a Citizens United problem. The way that imposing, permitting complete corporate integration, saying corporations don't have to pay any tax at all. That's a different thing.
No, so let me be clear if I wasn't clear. The base proposal, I think Professor Gratz, as well as ASI, would have some corporate tax. And whether it's 15%, I used 15%. 15% happens to be the targeted tax for ASI. So that would always be paid, but at the corporate level. And that... it's got its pluses and its minuses. That still leaves room for profit shifting and so forth. But it doesn't have that perception problem. And the rest of it's just arithmetic. I mean, it's true that somebody has to show a number, but they get to show a minus number, and a lot of people can't add and subtract. And I understand that that's an issue, but I don't think it's. I think it's a myth. It sort of reminds me of somebody told me about a VAT myth earlier, and I can't remember who it was.
We have an integration then. Excellent. Myth debunked.
Yeah. 2.
Yes. Wow.
Peter, do you think it's a problem if we have a corporate integration system and don't have a withholding tax on tax exempts? Do you think that's an inherent problem?
I tend to think we should have a tax. I don't know if it needs to be withheld on our tax exempts like it does in terms of collecting it. We might be able to trust them, but I think you do need a tax only because of the budget constraints and the concessions from where we are now to where they would be are enormous. Right now they're paying 35 cents on the dollar, 40 cents on the dollar with state and local taxes. And should that really go to 0, or should it go to 15 in my example, from 40 to 15 on 70, somebody on a group holding 30% of the corporate wealth of America? It's very expensive. So I'm not saying, look, I'm sympathetic to the concerns, but I'm not sure that that the concerns mean that the proposal should be dead on arrival. Or, I think it's got legs.
Moving on, our next question is for Allison. You wrote an article recently in Tax Notes International. It's generated some certainly heated discussions in our own workplace. A lot of very interesting water cooler conversations about this. It was called Spillovers and Tax Sovereignty. And you asked whether governments should...
Yeah, Bob was spilling his drink as he
it was. There was vodka in it, but that's beside the point. Should governments consider how their domestic tax reforms affect their trade partners? And apparently some countries in Europe are purporting to do this, maybe the Netherlands and Ireland. They're claiming to look at how their domestic tax reforms will affect their trade partners. But when I look at the debate over the last 12 months in the U.S., I don't see any talk about spillover effects. Right. I know there was one U.S. senator who was worried that the price of Mexican tequila might increase if we adopted the destination-based cash flow tax. But I don't remember anyone fretting over the effects on other economies. Now, some people would say that's not a problem. It's just a case of rational self-interest. Could you please guide us through your arguments and your analysis regarding spillover effects?
Well, I think Peter actually, he brought it up a little earlier when he said, if the U.S. switches to DBCFT, we have to worry, and I think Danny's sort of brought this up with the idea that the treaty network would be abolished or disbanded, or I think you said
neutered.
Exploded. I think you said blown up. Yeah, I was trying to not use a military term, but there. This idea that can one country take a policy that it knows will disrupt the expectations of a coordinated tax regime? Can one country do that? And it's so fascinating to me that we don't think about this at all, even as we're in the midst of a world in which tax havens are to be shut down, harmful tax practices are to be sanctioned. Countries are to be monitored to see if they are implementing the rules and standards set by 35 countries, 35 of the wealthiest countries in the world, of which we are all well represented. But the countries that are doing the things that we want stopped are not represented or haven't been in the past. So, for me, this question of spillover is a very interesting discussion because there was no discussion about why it is that a country should not adopt even what we might consider an egregiously bad faith tax policy if they do so as a democracy. Why should a country not have bank secrecy, set up, allow you to set up basically any structure? We didn't have that conversation in 1998 when the OECD declared the era of tax secrecy to be over. We did not have a conversation about why it is okay or it is appropriate to say this kind of tax planning is acceptable and that kind of tax planning is not acceptable, and countries have to agree. So, but there's been this discussion about what countries' expectations, rightful expectations are. So you have this report in 2011 by what we now are calling the Platform for Collaboration on Tax. You're familiar with the Platform for Collaboration, OECD, IMF, UN, and World Bank. And they have this 2011 report that encourages G20 countries to undertake spillover analysis, quote, of any proposed changes to their tax systems that may have a significant impact on the fiscal circumstances of developing countries in moving, for instance, from residence to territorial systems. So if you have, we are all G20 members, OECD members, UN members, IMF members, and World Bank members. We are members of all of these organizations, and they have issued a policy document that says, hey, when you start thinking about your tax system, you're considering structural changes, you can't do that in a vacuum. You have to look at the impact not just on your friends at the OECD, but on developing countries. Right. If they say that, we're saying that. So if we're saying that, right, then, and we're talking about DBCFT, right, it's a pretty big change.
Can I play the devil's advocate
Please.
just a little bit? So
Please.
There's a guy who said America first,
right,
and he won an election.
Right.
So
right.
Are you swimming against stream here? Or?
Yeah, I think absolutely. So I think that this tax sovereignty idea is another idea. We're going to debunk a third myth on the panel.
I love it.
Okay, it's another idea. We have this everyday notion about what tax sovereignty means. Tax sovereignty means that a people in a democracy ought to be able to choose what their tax system will look like because it's so bound up in the decisions about redistribution and burden sharing within a community. And that tax sovereignty must mean tax autonomy. Well, we know this is a myth and always has been a myth because, of course, we wouldn't have tax treaties if we didn't care about the impact that our tax system had on other countries and vice versa, the impact that their tax systems have on us. So America First is I think, It was wrong the first time it was proposed. It's wrong now. It's incorrect. It's not how you work in an integrated world. It's fine if you want to be isolated and don't want to have trade and investment, cross-border trade investment. But if you want those things, you can't say me all the time. You have to say, well, can we work this out? And that's, I think, at the end of the day, when cooler heads prevail, I'm not going to opine about whether I think that's likely in the short term or not. But in the long term, isn't it the case that the trend over the last century has been ever closer to more cooperation? Because we realize that lack of cooperation just fundamentally doesn't work. Each country cannot have a functioning tax system unless they're willing to sit down at the table and negotiate and compromise with other countries about what they're willing to live with. And, now that we have this peer monitoring and so on from the OECD, I think that it's very difficult to go back and say, well, we're not going to have any part of that, and we're going to just go our own way and expect the rest of the world to follow. Maybe they would. Now, can I say, though, I wrote a long time ago, not a long time ago, but some time ago, I wrote about the problem of subpart F. And I said, a lot of the difficulty of tax competition could be solved if residence countries would tax on the basis of residence, and the U.S. would abandon subpart F. But would have to be the first mover in doing that. And in the what was the plan that was proposed actually?
I'm sorry.
To eliminate subpart F, to expand subpart F to tax all income, active and passive.
To eliminate
simply flow through taxation.
Yeah.
That's a form of integration as well,
sure.
if it flows all the way through the individual shareholders.
Sure. Okay, and the reason that plan, it was the Baucus plan, I think, and the reason that plan was abandoned is because, and I don't quarrel with it, the reasoning is, well, but if the U.S. taxes that, they're not actually going to get that tax. The other country's going to get the tax because the other country's the source country, and we're going to get a tax credit. We're not actually going to get it, so going to worldwide taxation on a flow-through doesn't get the revenue in the U.S., so why would we do that, right?
We are able to, we've still been able to reduce taxes offshore by holding the line on check the box. And
right. Exactly.
So I don't think the U.S. is the biggest sinner in this area by far.
I don't think so either.
In fact, for many years they were the epitome of a good tax citizen in the sense that they were trying to export CFC regime. They were the first with the CFC regime. They were the last to reduce their taxes. They had a CFC, had a CFC regime and a 48% tax rate when I started practicing. And since then, there's still only about 38 countries that have CFC regimes, soon to be many more, I guess. But other countries have reduced their tax rates dramatically. And
But the deferral regime causing tax competition abroad has been good for American companies. Paying less tax in other countries has been good for American companies, and specifically American shareholders of American companies.
I will. I should have said that our good citizenry ended in around 1998 with Check the Box when we did not allow Treasury of its own initiative to say this is too good to be true, and Congress pulled the plug on that. And then I guess you'll say that we sort of doubled down with the proposal for destination-based cash flow tax, which we managed to make sure Action 5 was already written before we brought that up.
But I think there's a big ideological question about what kind of role the U.S. has or should have in ensuring that taxes are paid everywhere in the world. And I think we're going to see that play out. There was a Wall Street Journal article, is it today? It might be today or over the weekend, on how businesses are opposing the minimum tax that's being discussed at House, Senate, or the Big Six, Gang of Six, whatever they're called, because they feel that that's anti-competitive for them, but that goes directly to the point of should the U.S. have this role? And I think no other country really takes that on themselves to be the policeman of other countries' tax systems. So I have to ask why the U.S. should be the first mover in that respect.
I don't necessarily think territoriality is a good idea, but I think I recognize that is the trend. I think you're arguing against territoriality.
Yeah, yes. Yeah.
Well, you're much broader, right? You're saying holistically we need to be thinking about all the ripple effects of our tax system.
Right. I would like, there's some argument to say who can lead. If it's not the U.S., who is supposed to lead the way? And if the U.S. does not act like a good citizen, then how can you expect others?
Oh, there's always China.
Yeah. Good last word.
Well, we're going to end with a top 10 list that involves Dan here. Now, Dan, you've witnessed successful tax reform legislation before, namely the 86 Act. And I hope I'm not being presumptuous referring to the 86 Act as successful. I suppose some people would say the benefits didn't survive as long as they would have liked. Mm-hmm. But the point is you have a refined sense of what tax reform to succeed, what it looks like, both in terms of the process and the substance. Over the last year, you've had a chance to observe many of the tax reform discussions going on around the country, in academia, in commerce, on the Hill, the hearings and so forth. What impressions are you left with about everything we've been through and where we're going? Do you have a list of takeaways, a top 10 list?
Well, I actually had a top 10 list, but we've addressed a lot of those issues. So the question is, which of these observations am I left with?
Okay.
And I'll share a couple of those. One is that public support for tax reform is crucial, both in general and as a congressional priority. In the 1984, 85, 86 tax reform process, and it wasn't 3 weeks, it was 3 years. Mm-hmm. The public had an intense awareness of this. For example, this is a very weird example, but I guess this was 1985, I used to walk about 4 blocks to the metro station in Washington, D.C., and I walked by a studio of one of the network TV stations in the leading news program, and every once in a while there would be a reporter out on the street. And it so happened that one morning, a reporter stuck a microphone in my face and asked, "Well, what do you think about Congress repealing IRAs last night?" A man in the street interview. "What do you think about Congress repealing IRAs last night?" And I explained that Congress didn't repeal IRAs last night, that it was only the House Ways and Means Committee, and all they did was vote at the committee level to put an income limitation on IRAs for people who didn't have pension plans, which are the IRAs as we know it now. But the whole concept that is a discussion in the street between a reporter and a random passerby. That's what tax reform was like then. Ronald Reagan went on television and gave a national address about tax reform, and he was describing the principles that were involved in tax reform. He was presenting his tax reform plan, and I didn't bring a copy for show and tell today. I have been carrying one, but it's getting heavy. The president's tax reform plans in 1985, sometimes known as Treasury 2, was 461 pages long.
Right.
And now Donald Trump is presenting a tax reform plan, and this is the president's tax reform plan in 2017.
It's a little lighter.
We're not at the same level of leadership and awareness, and that's very important because
they were trying to save paper,
Trying to save, yes. Well, they could have saved paper by releasing it in soft copy and making it available on the internet. They didn't have to cut out 458 pages. But you need presidential leadership to get to the level of public support, to get a bill through Congress, to put it on the agenda, to make it a priority. And unless you do that, you're not going to get there. Because as we've seen in what Congress has been trying to do lately, even with single-party control, they can't get their act together to agree on anything. There has to be a president who's going to be able to say, listen, children, this is what you need to do. And I say you should do it. And I'm an important person. I say you should. And the president can't do that unless the president, and this usually goes without saying, but not right now, the president has to be accepted as the national leader. And if the president isn't accepted as the national leader, even if he goes on television, no one's going to listen to him, and he's not going to have the same effect that Ronald Reagan had in 1985. That you need public support, you need bipartisanship. You need to be able to, it's not, I think most people think it's not a good idea to try to get a major tax reform enacted in Congress getting it through Congress using the reconciliation process, which allows you to bypass the normal Senate structure and get a bill through the Senate with strictly a majority vote, which in most cases and right now means a one-party vote. Without involving the other party at all. You need a consensus. You need a national consensus and acceptance of something as significant as a major tax reform. And if you don't have that, you're not going to have the public acceptance. And if you don't have the public acceptance, you're not going to have the public support, and Congress isn't going to be able to do it. It all feeds on each other. So that's one observation. The other observation is that even with, as Mindy mentioned, there's no low-hanging fruit anymore in terms of broadening the base. But even when there was, in 1986, when there were major base broadeners, we had things like passive activity loss limitations. We had the 2% threshold on miscellaneous itemized deductions. The tax rate reduction for individuals was paid for by shifting $120 billion of revenue over 5 years from the personal income tax to the corporate income tax. And now the context is a corporate rate reduction driven tax reform. And they're hoping that maybe the corporate side alone can be revenue neutral, but more likely they're talking about a big tax cut for corporations. And of course you need an individual rate cut, otherwise the people aren't going to be interested in this. So how are you going to pay for that?
Yeah, Dan, I think that one of the most important aspects of corporate integration is the tie-in with business tax reform more generally. So this is one of the big issues that you're touching on. Can you just do corporate reform and not do the rest of the reform? And I don't think you can either. I think it's very difficult. And I will say the benefits of an integration proposal are much diminished, and it's much harder to push through if you're just trying to do corporate reform, partly for the reason you gave. I mean, I certainly agree with the cosmetic issue. But it is the only way I see that's rational to address the arguments for one rate of business tax for pass-through entities and corporate entities. So the pass-through entities are saying we should not be taxed higher at the business level than the corporations. And they probably have the political strength to pull that off. But that's an irrational system at the end of the day. And how can you address that? You can only address it by reducing the other side, which is the integration. So I think that reform should be much more comprehensive than business tax, than just business tax. It has to include individuals and pass-through entities, and that's just. And I think if that takes time, and I think one of the problems, one of the major problems right now is that they're desperate to do something, or that it comes across that way. And I don't think it's quite fair to compare Trump's one-pager with the 472 pages. That was Treasury too. Reagan had been in office for quite a while, but they did have the good sense to take their time, and that process, that reform proposal had been worked on for 2 or 3 years, right?
And this administration decided to put this out before, rather than doing that kind of work. So
it was calling it a plan when it's just principles, and it's still just principles. And as principles, it's okay, but that's.
If I understand you properly, Peter, you're suggesting that the integration proposal would be revenue neutral to the entire economy, but shift a significant amount of corporate tax revenue to the individual taxation. Is that where this would be going?
It would result in overall tax cut to individuals that somehow has to be paid for. maybe through a reduction in interest deduction or something at the business level. But it does cause the tax to be paid at the shareholder level instead of the corporate level. Yeah.
So if this is going to be a revenue-neutral tax reform, you'd be shifting revenue back from corporate income taxation to individual income taxation.
Now, in reality, it may not be, because for the same reason in '86 they did not. They called it revenue neutral. I'm not sure it was, but it at least tried to be. But most proposals since then, it's been very difficult to come up with revenue neutral proposals, and you just have to buy it off to get a system in place that you think might be better, and you can tighten the screws later on. But maybe. So that's
notwithstanding Citizens United, it's the individuals who vote, and they tend to vote against congressmen who vote to raise their taxes.
Okay.
So basically, you're saying 2017 has little in common with 1986. It sounds like.
I think that's right. I think it has very little in common with 1986.
Mindy, Allison, final words, thoughts on this?
It's a depressing thought.
Well, regrettably, that's all the time we have for today. We'll have to continue this discussion at another time, perhaps at next year's IFA Congress, or perhaps when we get a bill with actual details and a revenue score. My fingers are crossed that will happen sooner rather than later. Until then, I want to personally thank our panelists for being generous with their time. There are a lot of competing demands on them during the week of the IFA Congress. We recognize that, and we sincerely appreciate their participation. Dan, Allison, Peter, Mindy, we couldn't have done this without you. Thank you so much. Until next time, I'm Bob Goulder for Tax Analysts, and take care.